What's up, traders? So today I'm going to show you how to effectively do the wheel strategy on SoFi in order to bring in consistent and reliable income every single month. And not only does this trade bring in a high rate of return, but it's also very good for small accounts. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple six figures a year from the stock market. And I use the money that I make from the stock market in order to pay for my entire lifestyle. But before we get started, make sure that you hit that like button and subscribe to the channel. And do remember that I am not a financial advisor, and this is not financial advice. All trading comes with risk. I'm just showing you how I've built wealth over time. Now, before we get into the aspects of the trade, let's look at the fundamentals of SoFi. All right, so SoFi, they advertise themselves as a financial tech company, but to put it simply, they are an online bank. They offer both personal and checking accounts, and they have a ton of different loan options. So if we look up here, you can see that they have student loan refinancing. And if you went to school, you probably received a letter from them at some point in time. And then they do private student loans, and they do personal loans, such as home improvement loans, credit card consolidation, family plans, travel loans, and even wedding loans. Now, I'll be honest, it wasn't until I visited their website that I even knew that wedding loans were a thing. And listen, lovebirds, I mean this with all kindness. If you need to take out a loan for your wedding, it's probably time to cut down on some of the wedding expenses. Okay, and this is coming from somebody who owns a photography company, and we shoot tons of weddings per year. I'm telling you right now, taking out a loan for your wedding is not going to be worth it in the long run. Okay, but those are some of the personal loans that SoFi offers. And then they have mortgage loans as well, refinancing, HELOCs, home equity loans, et cetera, et cetera. Okay, but in short, they are an online bank. And if we scroll down, they've been having a ton of growth lately. And now they have over 10 million different members. And their platform is very modernized. So it certainly appeals to the millennials and the Gen Z crowd. But let's take a deeper dive into their numbers. All right, so we can see it is currently a $10.98 stock, which is partly what makes it so great to trade for small accounts. And then the market cap is currently 11.8 billion. Its PE ratio is 82, which means if you're buying it just based off of the fundamentals of the company, it's pretty expensive. However, we'll discuss more on that here in just a bit. And it looks like they have an upcoming earnings on April 29th. Now, taking a quick look at their revenue and net income, you can see here over the last 4 years, the revenue has been growing consistently. And they just recently in 2024 had their first year where they had positive net income. So that is a great thing to see. And if we look over here, we can see since 2021, their net income has been going up every year. So they lost 483 million in 2021, and then they lost 320 million in 2022, then 300 million in 2023, and then they had a positive 498 million in 2024. So it is good to see both their revenue and net income increasing every single year. Now, as far as analyst ratings, there are currently 18 analysts that cover the stock, and collectively they do have it as a hold. However, they have it as a mean target of $13.80, which it is currently trading for less than that. And some analysts have it as high as $20 and then a low target of $4. But the fact that it's currently trading less than what the mean target is currently is a good sign. And so let's go ahead and take a look at the chart. So we can see here throughout 2024, it traded in a very tight range. However, about October of last year, the stock skyrocketed from around $8 and went all the way up to 18, where it peaked in January of this year. And then it started trending downwards, and now it's trading anywhere between $9 and $13 roughly. And with all that information, let's take a look at how we can start the wheel strategy. Now, first things first, what is the wheel strategy? Now, if you're new to options, I'm going to explain everything now. However, if you're already familiar with the option strategies, make sure you stay to the end because I'm going to show you a better and more effective way to go about it. All right, so with the wheel strategy, the first thing you want to do is sell a put. And when you sell a put, you are agreeing to buy a stock at a cheaper price. And for selling a put, you receive money. And then once you buy the shares, you can turn around and sell a covered call. And with a covered call, you are just agreeing to sell a stock at a specific price. And when you sell covered calls, you collect money as well. And then once you've sold the shares, you have completed the wheel strategy. But that's why it's called the wheel strategy, because you can just continue to do those steps over and over and over again. But let me break down selling puts and selling covered calls a little bit more. So when you sell a put, there are two main objectives. And it's one, to generate income, or two, to buy the underlying stock at a cheaper price. So when you sell puts, you either one, want to make money, of course, and or two, you want to buy the stock at a cheaper price. And selling puts is literally like selling insurance for stocks. And here's what I mean. Let's say I have ABC stock that is currently trading at $100 and I like the company and I want to purchase the shares. So I could potentially sell a put at, let's say, $90. And as I'm selling a put, I'm essentially saying to the buyer, hey, I will buy your shares of ABC stock that are currently trading at $100 and I will buy them from you if the stock crashes below $90. However, for doing so, you have to pay me, let's say, $200 right here, right now. And this contract is only good for the next 30 days. And from there, two things can happen. Let's say ABC stock stays above $90, then we just keep the $200 we were paid and we go about our day, and we can do that trade over and over and over and over again. However, scenario number two is if ABC stock drops below $90, then we still need to purchase the shares of ABC stock at the $90 that we agreed upon. However, we still keep that $200 that we received. And so as a put seller, you are essentially selling insurance for the stock. And just like with your car insurance that you pay every single month, the insurance company keeps the premium that you pay them whether you get into a car accident or you don't. And so here's a quick example of selling a put with a real stock. So let's say Apple stock is currently trading for about $220. And let's say you're interested in buying Apple stock at a cheaper price. Then what we could do is we could sell a put, let's say at $200, and that would be our strike price. And we could select an expiration that is 30 days out. And for selling this put, we would receive $150 immediately right here, right now. And so if we look at this profit and loss chart over here, so Apple stock is currently $220. If the stock price were to go up, then we just keep the $150 we received. If the stock price stays the same, then we just keep the $150 that we received. If the stock price goes down some, we still keep the $150 we received. However, if the stock price dropped below our $200 strike, then we will be forced to buy 100 shares of the company per contract that we have. And that's literally how selling puts works. However, now let's go and take a look at the few data points that I look at prior to selling puts. So the first thing that I want to take note of are the Bollinger Bands. So the Bollinger Bands are these black lines up here, but the Bollinger Bands just aim to show you the range that a stock is expected to trade within. And normally it's about 95% accurate. So you can see going back all the way to 6 months ago, it'll trade within it, and then sometimes it'll pop out for a few days, but it always goes back in. All right, pops out, goes back in. And that process just continuously works over and over. And as of right now, the Bollinger Bands show a range of $9.61 on the low end and $12.65 on the high end. So when it comes to selling puts, I just want to take note of that low end, which is $9.61, because there's a good chance that I'm going to sell puts either around that mark or maybe a little bit lower. But now let's head on over to Thinkorswim so we can look at our other data points. So here we are in the options chain of SoFi. And the first thing I need to do is select the expiration date. Now, I typically always go for an expiration that is within 45 days. But since we're interested in some monthly income, let's go around 30 days. And we can see that this May 16th expiration date is 31 days out from now. So I'll go ahead and select that. And the next data point that I want to look at is the expected move. So if we come over here, we can see this plus or minus number here. And it says a plus minus $2.48 currently. And that is just the maximum move that the options market has priced in as of right now for this expiration date. And so on the lower end, that would put us around $8.50 as the expected move. And so that is good information to have. And then the next thing I want to look at is the delta. So the delta is this column here. But by definition, the delta is how much an options premium will move per a $1 move in the underlying stock's price. However, most successful traders use the delta as the probability of the event occurring. So at this $9 strike, we can see it has a delta of 0.21. So that's saying there's about a 21% chance that SoFi, which is currently at $10.80, drops down to $9 by this expiration date. So in other words, you have about a 79% probability of profit if you were to sell puts at that $9 strike right here, right now. And for me, typically I go with a delta of around 0.20 or lower. However, if I really want to buy the shares of the company, I may go a little higher on my delta. All right, so those are the 3 data points that I like to look at prior to selling any puts. And so with that being said, I would either go with the $8 or the $9 strike, but I think that the $9 strike is the best option in this scenario. And looking at the $9 strike, the bid and ask price is 0.42. to 0.44. Now, if you're new to options, that is the price that you will be paid per contract if you were to sell this put. However, every contract is worth 100 shares, so you'll always get 100 times the amount that you see. So if I were to sell a put right here, right now, I would get anywhere between $42 to $44 right here, right now. So let's go ahead and select the bid price, and your brokerage will automatically set up the ticket for you. So we are selling, and then here you can select your contracts, and this is really up to your risk tolerance and the size of your account. And there's absolutely nothing wrong with doing one contract at a time. But let's say for this example, since it is a lower price stock, that we do maybe 5 contracts. And we have it set for May 16th at the strike of $9, and it is a put. And at the mid price, we'll get about $42 per contract. So once you have that set, you can go ahead, hit review, and place the order. However, let's head down to the profit and loss chart. So taking a look at the P&L chart, I want you to pay attention to this number that you see here. But right now, SoFi stock price is where this red dot is here. And so we can see for this trade, we were paid $210 up front because of the 5 contracts. And if SoFi stock price were to go up, that $210 is how much we make. If the stock price stays the same, that $210 is what we make. If the stock price goes down some, that $210 is what we make. However, once the stock goes below $9 is when we start to make less money. And then our break even is right around $8.58. And then if the stock price were to go down even more, then you will start to lose money on the trade. However, that doesn't matter for us because we are fine with purchasing the shares of the company that we selected at the strike price we selected. So the only reason we would have entered this trade to begin with is because we were fine with purchasing the shares at that $9 mark. So let's say that the stock price did drop below $9 by your expiration date and you were forced to buy the shares. Well, that's perfect. So now we need to do the second step from the wheel strategy, which is sell calls. And so the objective with covered calls is to generate income and profit from a stock that you already own. And that is the reason it's called a covered call, is because you already own the shares of the company. So when you go to sell a call, it is covered by the shares that you own. And here's a quick example using Apple again. So let's say we own 100 shares of Apple at the $165 mark. That's the price that we paid for the shares. So that is our cost basis. Well, now we could turn around and sell a covered call, let's say for this example, at $185. And we'll still do it for 30 days out, and we received $200 for doing so. Well, if we look over here at the profit and loss chart, this is how this works. If Apple stock goes down, you keep that $200 that you received. If Apple stock stays at around $165, you keep that $200 you received. If Apple stock goes up some, all the way up to $185, you just keep that $200 you received. However, if Apple goes above $185, then you still keep the $200 that you received. However, now you are forced to sell your shares at that $185 mark that you agreed upon. But here's the great thing about covered calls, is not only do you get to keep that $200 option premium that you received, but you also get the capital appreciation of the stock. So we bought the shares of Apple at $165. And if it goes above $185, then you still get to collect that $20 price appreciation on top of the premium that you received. However, now you cap your capital appreciation at whatever strike that you selected because you agreed to sell the shares at that price. And so let's go ahead and take a look at a covered call. So now we're back over here at the options chain for SoFi. And let's assume that we had previously sold puts at, let's say, $11 and we were assigned. And now SoFi is trading for $10.80. Well, now we can come over here and sell covered calls. So the calls are always over here on your left side. And when you're selling a covered call, you can be even more aggressive than you were on the put side. And to be honest, me personally, I love selling covered calls somewhere around my cost basis. And so in this case, if we bought the shares at $11, I could just turn around and sell covered calls right at $11 as well. And we can see that pays an amazing price, currently somewhere between $101 to $104 per contract, which will be almost a guaranteed 10% return in 31 days. However, let's go a little further down. Let's do the $12 strike, which still pays an amazing amount. You'll get anywhere between $61 to $63 per contract. And here's a little bit of how that would look, because now we not only own the shares of the company, but we also have this options contract. So as the price of SoFi slowly moves up, you can see there at the bottom left that the amount we make for the trade goes higher and higher, and then it will cap out at $12. But you can see with the capital appreciation of the stock and the premium we received, that would be $165 worth of profit per contract that you have. And so you can see there that you often make even more money once you get assigned the shares from selling the puts, because on the covered call side, you also get the capital appreciation of the stock. And that is the real strategy. And I love it because you can consistently just do this every single month and make money around the clock. But this is something we are doing within the community. And if you know anybody that could benefit from learning how to generate consistent and reliable income off the cash that they already have, then tell them about the Trade to Freedom community. The link is in the description below. Not only will they get my exact trades when I enter them, in which we have strategies all the way from 0 DTE, which is for day traders, all the way up to monthly income for our individuals who are much more busy. And they'll also get my entire options framework via the Trade to Freedom course. They'll thoroughly be able to ask me questions at any given time. And lastly, they'll be within a community of other traders who will all have the exact same goals as them. So if you know anybody who needs to generate consistent and reliable income, then send them the link below. But that is it for this video, and I will see you guys on the next one. Peace!